founders do not give up. They know that when the market comes back, they're going to be back in growth mode, so they're just getting conservative with capital. Welcome back to the Inorganic Podcast. My name's Christian Hassold. I'm your host, and this is episode 16. It's been probably, a month since I posted my last episode. And I know you've all been missing me and my insights on the market, but I took a few weeks off, hopped over the pond with a million other Americans, it seemed like, to go see Taylor Swift in Amsterdam. It was awesome, of course, and also spent some time cruising around Belgium. So got some really good R&R and had a lot of time to think about upcoming content for this episode. In fact, some of the episodes that I'll be recording over the next few weeks were actually developed on trains in different part of Europe. So that was pretty fun. One kind of crazy insight is just going back to like how many Americans were in Europe to see Taylor Swift, whether it was in Amsterdam or London or in Germany. You know, if you think about kind of the cost of a plane ticket to Europe, it's about $1,000 a person. Getting into a Taylor Swift show anywhere in Europe is anywhere between $1,500 and $2,000, which is a lot of money. And then kind of the hotel and all the other stuff. It's sort of shocking, but kind of laughable that the end-to-end cost for going to Europe for a family of 4, and I saw a ton of families over there, is just cheaper to go to Europe, or a better value in some folks' eyes than going to spend $3,000 a ticket to sit in the nosebleeds and watch a show in Miami or wherever she's coming. I even looked at the Miami tickets as I was coming back over. They're like $3,500. So it just kind of is funny that it's a better deal in Europe, but good for us, I guess. And it was a great show. So super glad I went. All right, switch gears. Let's get into the episode. This episode, we're going to do a mid-year market update. We're going to talk about the macro activity that's feeding sort of the M&A market for SaaS companies. Talk a little bit about the climate for M&A and kind of some of the, the politics and conversations that are driving, that activity at the macro and kind of the mid-level. And then we'll actually go back to a prediction I made at the beginning of the year and see whether I was right or whether I was wrong about SaaS M&A ticking up. And then the third thing that we'll do is take a look at 4 specific deals that actually got done this quarter to just get a sampling of the kind of deals that are getting over the line in enterprise SaaS. So let's start with the macro picture. There's a couple of big factors that influence the downstream M&A market for SaaS companies. Factor number 1 is generally interest rates. Like if interest rates are high, then cash is expensive and companies are going to be more careful about the cash that they deploy because it's expensive to deploy capital. And in a market like this, either preserving the cash, doing share buybacks, or making other investments may be a better way to grow or expand or protect the business. The second thing is a little bit about kind of the politics of the current administration. And this isn't a political podcast. It's more of a representation of some of the sentiment in the VC market, which is the current leadership of the FTC is being much more restrictive about M&A activity, which is just sort of discouraging M&A activity in the market. And then the other dynamic is IPOs are still not really happening. And when IPOs are not happening, then investors are not putting capital into startups, Series C and Series D companies. And a lot of time, capital coming into Series C and Series D companies are going to be used for inorganic. So if you think about all those dynamics kind of coming together, it's generally still a slower M&A market. And we're going to see that in some of the data. There's 2 points that I want to highlight besides just saying that the IPO market is dead. What I want to do is kind of go into something that I picked up from one of my favorite podcasts, the All In podcast, which is a really deep conversation about kind of why M&A is so hard for large companies that are private or public companies. And that's because there's a sentiment that Lina Khan, who's the current head of the FTC, is just being a little bit too broad brush in the approach that they're taking to oversight of tech acquisitions of deals, instead of being a little bit more focused on kind of the things that are actually potentially a threat to monopoly and control, which is generally what the FTC should be looking after is, as a company becoming a monopoly. This is said best by one of my favorites, David Sachs from the All In podcast.
And the reason for that is because Lina Khan, for all of her faults, and we've described them here, has been willing to take on big tech. The fact of the matter is that the top handful of tech companies, the Microsofts, the Googles, Amazon, these are big tech monopolies. There's just no way around that fact. And they do need to be closely watched and supervised and regulated with respect to their market power. I sometimes think that Lina Khan, in her approach, has been a little bit more of a cleaver when she needed to use a scalpel. I don't think that she should stop some of these, what I would call R&D acquisitions.
And so in a nutshell, what David's saying is like, there's just too much of a broad brush approach to the FTC's oversight of M&A, which is causing public companies to say, you know what, it's not worth the time or the expense or the pain because we know how this is going to work out. If the FTC reviews an acquisition, it's not months. It could be a year for the discovery to take place, for all the legal proceedings to occur. And that's just a lot of expense and time. And at the same time, you've kind of got a deal that's just sort of waiting for FTC approval, which, by the way, is publicly announced. So there's all sorts of other challenges that it creates for the acquirer and especially the acquired, because there's a lot of uncertainty. So if you're in a climate where the FTC is going to review a deal, it just makes it a little bit harder. And that has a downstream impact on the market because typically the kinds of companies that are going to get acquired by a larger company are these Series C, D, and E companies. And so when that happens, that just has a big impact because investors like TPG and PSG and Insight and HG, they're just going to be much more careful about how they deploy capital into these late stage companies. So that's just a sense of kind of what's happening in the market. But let's take it a layer deeper and actually look at deal activity through two lenses. Lens number one is PE-backed M&A activity. That's PE sponsors buying software companies. And the second is corporate sponsors buying SaaS companies. So this is data from PitchBook. I'll link the source in the notes of the episode, but let's go ahead and take a look at the data. So the first thing that I want to do is look at PE sponsor-based activity. This is PE investors like TA, Thoma Bravo, HG, and Vista. If you look at the activity from 2023 and coming into Q4, you note a couple of things. One is from Q4 to Q1, there was a significant drop in deal value, while at the same time, the volume of deals substantially increased. So we went from roughly 40 deals and about $35 billion in deal value in Q4 to roughly 60 deals in Q1 at about 12 billion in valuation. So deals go up and deal sizes go down. You could read into that as valuations cratered. You could also read it as maybe some PE sponsors were going for some much more opportunistic, smaller kind of deals where there was a lot of growth opportunity, buying 100 million ARR company that's growing at 30% versus a $50 million company that's growing at like 50 to 60%. There's two completely different profiles. You might pay a little bit differently for it. So, in the data here, there's some underlying questions about what's actually happening, but at a high level, you can infer that overall the deal activity is up, but the average purchase price appears to be down a little bit, the PE sponsored front. On the corporate sponsored front, we're talking about companies like Fullstream, Verisec, Avalara, Salesforce. Those are some of the bigger acquirers over the last few years. Deal activity from Q4 2023 to Q1 in terms of dollar volume is roughly still about, looks like 20 to 25 billion in quarter over quarter, just slightly down in Q1 2024. Deal volume slightly up in Q1 2024. So we're seeing a small uptick of what you probably call opportunistic activity. So if you look at both PE-backed and corporate-backed M&A, its overall deal volumes up a little bit, but values are down substantially. If you combine the two, they're down substantially, or at least a little bit in corporate. And so that just kind of speaks to a softness in what people are willing to pay for deals. My own view of what's happening in the market, as you know, I spend most of my time working with PE sponsors on deals, talking to PE sponsors about the kind of deals that they're doing, and a little bit of my own experience running corporate development in a enterprise SaaS company. I'm seeing three dynamics. Number one is deals are just getting stalled. They're getting stalled because the buyer and the seller can't agree on a purchase price. One, what the buyer is willing to pay, and two, what the seller is willing to take are two completely different things. The second element, the reason why deals are getting stalled is, the last 18 months for enterprise SaaS have been pretty tough for growth rates. So what you see is there are companies that took a benefit from COVID where their growth rates really spiked. And then coming out of COVID, those growth rates kind of came back down. And maybe the growth rates they're looking at or forecasting are anywhere between 5 and 10%. When they're presenting a SIM on a deal, of course, they're going to say, yeah, it's going to go up to 15 or 20%. Just give it a couple of years. It's really hard for sponsors, whether they're PE-backed or corporates, to get really confident about what those growth rates are really going to look like. How long are we going to be in this winter? A lot of the buyers of enterprise SaaS technology, they're just being a little bit more rational and a little bit more careful about what they're willing to buy. That does depend from one category of product or another. Maybe security is doing a little bit better, or, like pharma tech, maybe doing a little bit better. But then there are other categories. I operate in e-commerce where things are just a little bit softer because in a lot of cases, the buyers are generally just being a little bit more finicky about what they're willing to invest in and what they're willing to pay for. So there are sort of category level dynamics, but overall, still seeing a fair amount of stalled deal activity. In the deals that are getting done, what I'm seeing very frequently is existing investors, in order to get a deal over the line, are willing to roll a more material portion of the cap table into the next deal. What that means is an existing investor usually sells a company and says, look, I'm looking for a full buyout. Take this whole thing. I want to get my return in my cash and move on to the next investment. There are a lot of cases where existing investors are rolling 5 or 10% to kind of come along and see where the next investor can take the company, especially if they generally are excited. They just need to rotate out of that investment because of the time that they hold is coming to an end. But what I'm actually seeing is the existing investors rolling anywhere between 30 or as much as 40%, giving up control of the company, but retaining a material hold of the existing cap table. And they're doing that because they want to take cash, put it back on their balance sheet so they either can close out a fund or just mark an investment at a valuation point so they can continue to raise for another fund that they might have, that they might be raising for. It's a lot of underlying dynamics happening and why a deal is getting done, and the dynamics and the structure in which that deal is getting done. We had talked a while back in terms of the creativity that is happening between buyer and sellers in order to get deals done. And this is kind of an example of that creativity. When you're talking about larger deals, generally the creativity is sort of what are the kinds of special considerations that an existing investor is willing to agree to in order to get a deal over the line. There's a lot of other downstream stuff I won't get into this episode, but at a high level, there's a lot of creativity around the structuring. So, back to it, it's like the bid-ask spread is sort of still there, and it is still there. And that's one of the challenges that's kind of muting the ability for more volume to take place, more deals to get done, and, back to those macro conditions that we covered. Now, I want to turn a chapter here and go back to the prediction that I made in January. I had made a prediction that more startups would be buying startups in 2024. Essentially, that I had a feeling it would be skyrocketing. Those are my words. I'm holding myself accountable. I said that SaaS M&A would skyrocket. Well, again, thanks to our friends at Carta, we can make myself honest against my prediction. My prediction has not really panned out. It turns out I'm not the only person. Jason Lemkin and others who are pretty smart people had also predicted an uptick in SaaS M&A. If you look at the Carta data, what you can see is from Q4 2023, 141 deals. Same number of deals got done in Q1 2024, and then 147 deals in Q2 2024. So just very slight elevation between the two. What we are seeing here is still overall a healthy M&A market of startups buying other startups. Generally, seed and Series A and Series B companies are getting over the line, but it's not up like I predicted. And I think the one insight that I have in terms of the reason why it's not up is kind of two factors that are one factor that's not surprising and one factor that is surprising. The factor that is not surprising is founders do not give up. The best founders just do not like to give up. And what I see a lot of founders doing in order to avoid having to raise or seek acquisition is they get the business to either profitability or just a little bit above profitability so they can ride out what they believe to be the storm. They're convicted on their business. They've got the right team. They know that when the market comes back, they're going to be back in growth mode. So they're just getting conservative with capital. Not surprising at all that founders would be of that mindset in the majority, looking at all the numbers. But the one thing that is surprising is I would have expected investors to be a little bit more activist and kind of pushing founders to make a decision. Like, look, this isn't going to get better. We don't know on what time frame it's going to get better. It's really in your best interest to seek an acquisition, spend a couple of years at the acquirer, pass on the torch and go start your next company. Whatever your next company is, it'll probably be 2x whatever you did here. That's usually the kind of way that I see investors thinking when they're having that conversation, but they're not actually forcing the conversation in the boardroom. They're not actually forcing the conversation in the boardroom. And people will say, well, Christian, why would you expect an investor to do that? This is an extraordinary time. This is a very extraordinary and difficult time to raise capital. There's a lot of scrutiny on fundraising. Even if these companies in another year kind of come out of this weather and growth rates creep up a little bit, is it really enough to get them the fundraise that they need? And to get back into growth mode, you're going to need to burn again in most cases. So how are you going to do it? What's that outcome look like? So investors, in my view, generally are just not getting very activist. They're letting the founders make the calls unless there's some exceptional circumstance where they're out of cash and they're burning and they have to either shut down. I'm waiting for the carded data on SaaS companies shutting down. Is probably still a material volume of maybe 300 or 400 a quarter, but that's not that 300 or 400 a quarter in the scheme of 60,000 SaaS companies is a pretty small map. So that's my readout on the macro and some of the statistics on deal activity taking place. Let's actually switch gears again and look at the deals that actually have gotten done in the last 6 months. There are a lot of deals that have gotten done, but what I wanted to do in this episode is just go through a sampling of 4 specific deals. 3 are public company backed deals, and 1 is a PE sponsored backed deal. Let's take a look at deal number 1. The acquirer was Cloudflare. I know it's not a popular company right now for a whole lot of reasons, but they've been acquisitive. And one of their recent acquisitions was a Boston-based company, Bastion Zero. Bastion was a platform designed for IT and security teams to manage remote access to company systems. Very timely. Bastion was founded in 2017. They had 11 employees. They had raised $11 million. Their last raise was $6 million on a post money of $22 million. And they had raised from a combination of Underscore, which is a very well-known seed investor in Boston, Dell Capital, as well as a handful of angels. The deal value of this deal was not disclosed. And so what I'm going to infer from this between the raise, the number of employees, and the fact that the deal value wasn't disclosed is that this probably was a smaller deal or kind of a creative deal where maybe it was some stock and some cash for the founding team. I haven't reached out to them, but just going to kind of read through the lines and say this is probably an example of a creative deal. When it's 11 people, they've raised $11 million and they're not announcing the terms. It's not a strategic multiple the vast majority of the time. So that's probably what this deal was. Nonetheless, a great outcome. Cloudflare is a great company. The employees and the founders are probably grateful for that opportunity. Deal number 2 was Akamai's acquisition of No Name Security. No Name was a San Jose-based API security company, And the announced acquisition price for that company was $450 million. That's a great amount of money, except there was one thing. We'll get right to that, which is the post-money valuation of the company. We'll get there in 1 minute. But let's just kind of go through some of the stats. No Name was a company founded in 2020, so a relatively recent company, but they had 471 employees. And they had raised $220 million from the likes of Insight Venture Partners, Lightspeed, and ForgePoint. The post money on their last raise was $1 billion. And so that acquisition price of $450 million was about a 50% haircut off of its post-money valuation. However, it's kind of a bright light that they've raised 220, they got 450 out of the deal. So if you're the investors, you should be pretty happy about the deal that you got done here. It was at least double the amount of money raised. That probably means a half decent outcome for the founders. And Akamai is a great company, so a good deal for the company, for the acquired employees as well. That's deal number 2. The next deal that got done was DocuSign's acquisition of Lexon. This is a smaller company, a Seattle-based provider of AI-powered agreement management software. There's the AI part. So public company doing an AI deal. Lexon was founded in 2018. It had about 114 employees at the time of acquisition, and they had raised $36 million from a combination of Khosla, Madrona, which is a Seattle-based venture firm, and Point72 Ventures. So the post money that they had raised that $36 million on was $77 million. So $165 million cash deal on a $77 million post, about 2x their post. That was a great deal. And that's kind of like speaking to the power of an AI deal. So that was great for the founders and a great outcome for the employees, I hope, and a great win for DocuSign investing in AI. The last deal that I want to highlight is SentinelOne. SentinelOne acquired PingSafe, which was a San Francisco-based cloud-native application protection platform, or CNAP as they say. This acquisition was for a combination of cash and stock. There wasn't a public announcement about the deal value, but it looks like, according to PitchBook, that the reported deal value is about $82.9 million. This was a company that was founded in 2021. They had 70 employees. And what was really awesome about this deal is they'd only raised a $3.2 million seed at a $13.2 million post. So $3.2 million raised and $82.9 million for the deal. What a great outcome for the founders and for the employees. I'm sure that everyone got a really good, beyond the investors, I'm sure the team were really proud of the return there. 70 employees. There's a fair amount of cash to go around for those who had a material amount of stock. So that's a great deal. So if you look across these 4 acquisitions that have occurred over the last 6 months, you're seeing kind of one example of a very opportunistic, probably just a good deal for the founders in that Cloudflare Bastion deal. And then across the other 3 deals, it's like not really bad. It's actually kind of a good outcome. So those are the kinds of deals that are getting done. My guess is that outside of the Bastion Zero deal, and I'm waiting for the Bastion Zero founder to be like, hey, why are you talking crap about my company? Not at all. It's just sort of like when 11-person company getting acquired by a big company is a great deal. It's awesome that happened. I'd be suspicious if it was for a material amount of money, but the other deals, materially reported acquisition prices. And so we're seeing some good signs in those deals that are getting done. I'll try and, when I do my Q4 update, to get a little bit better of a sampling and maybe go into some detail. But I thought for the first time I'd experiment a little bit and actually go into an example of some SaaS companies buying smaller SaaS companies to just give us a sample of what's happening in the market. So coming to the end of the episode, overall, just summarizing, once again, M&A activity is up a little bit, but it's still pretty muted from where it's been over the last couple of years. Startups are still buying startups, but not at the levels that I've predicted. And some good deals are getting done. Corporates are buying some of these smaller companies. Some of the commentary that we heard earlier about there being a lot of FTC scrutiny. Clearly, some deals are still getting done, even with that kind of level of scrutiny being reported or talked about on the wires. So really good read on generally what's happening in the market. I hope the content that I shared with you on this episode was super helpful. I've linked both the All In podcast episode that I cited, as well as the PitchBook and the Carta information shared in the episode in the show notes, so you can take a look at those and double click on them if you wanted. That's all for this episode. Thanks for joining me. If you enjoyed the content, please do like and subscribe, and I'll see you next time on the Inorganic Podcast.